Welcome to the full ACCA Performance Management Revision. Chapter 1. Traditional Costing Methods. Management accounting begins with costing. Two major costing approaches you need to remember are absorption costing, where all production costs, including fixed overheads, are absorbed into the cost of the product, and marginal costing, where only variable costs are charged to products and fixed costs are treated as period costs. The key difference is in profit reporting. Under absorption costing, inventory carries fixed overheads, while under marginal costing, profit changes directly with sales volume. Next, we revise standard costing. This is a system where costs are predetermined for materials, labor, and overheads, and then actual costs are compared against these standards to find variances. Standard costs are powerful because they set benchmarks and allow managers to investigate differences between expected and actual performance. Use of standard costs. Why do we use standard costs? They help in planning by setting expected costs. They support control by highlighting variances. They are useful in decision-making since variances show efficiency or inefficiency. Types of standards. Standard can be basic standards set for long periods and rarely changed. Ideal standards, which assume perfect efficiency with no wastage. Currently attainable standards, which are realistic and achievable with some effort. And normal standards based on average past performance. Definition recap. In short, standard costing equals a predetermined cost system plus variance analysis for control. Another key revision area is budgeting. In PM, we focus on how budgets behave with changes in activity levels. A fixed budget is set at one level of activity and does not change, which can be misleading if actual activity is very different. A flexible budget, on the other hand, adjust with activity levels, providing a fair measure of performance. Fixed versus flexible budget. Think of it this way. A fixed budget means we plan to make 10,000 units. A flexible budget means if we actually made 12,000 units, here's what the cost should have been. This prevents unfair variance reporting. Flexed budget. A flexed budget is prepared after the fact at the actual activity level, but using budgeted cost data. This lets us isolate efficiency variances instead of just volume variances. Controllability and performance management. Finally, budgets and standards must be linked to performance management. Managers should only be held accountable for costs they can control. This is known as the principle of controllability. For example, a production manager should be evaluated on labor efficiency, but not on material price variances if purchasing is handled by another department. This ensures performance measurement is fair and motivates the right behavior. Summary. So in summary, we revised traditional costing, absorption versus marginal. We refreshed standard costing, its use, types of standards, and variance control. We explored flexible budgeting, why it is better than fixed, and the role of flexed budgets. Finally, we linked everything to performance management and controllability. Mastering these basics ensures you can handle advanced PM topics like advanced variance analysis, decision-making under risk, and performance measurement in a real-world context. Welcome to Chapter 2 of Performance Management. In the next 5 minutes, we will cover how information, technologies, and systems improve organizational performance and decision-making. Let's start with what and why of information systems. An information system captures, processes, stores, and delivers information for planning, control, and decisions. It supports day-to-day operations and also helps managers plan, measure performance, and exercise control. High-quality information must be accurate, complete, cost-effective, understandable, relevant, accessible, timely, and easy to use. From data to information. Data are raw facts. Information is data that has been processed to carry meaning. We create information by classifying, summarizing, analyzing, and presenting data so that managers can make better decisions. Sources of management information. Internal sources include ledgers, payroll, production records, asset registers, and sales and marketing systems. Examples include invoices, hours worked, machine downtime reports, and customer or product analysis. External sources include suppliers, customers, government publications, and professional or market journals, such as price lists, specifications, inflation statistics, competitor actions, and demographic data. Cost, benefit of information systems. The benefit of an information system must exceed its cost. Initial costs include software and hardware, testing and implementation, and training. Ongoing costs include staff time, technical support, maintenance, and upgrades. Also consider indirect risks such as information overload, operational disruption during change, system incompatibilities, or project failure. Aim for an optimal reporting frequency that supports decisions without overwhelming users. Classifying information costs. Internal information costs include direct data capture, processing by staff, and management overheads. External information costs include subscriptions, time spent searching, and the infrastructure required to manage sources. Hidden costs may include training time, temporary loss of productivity, morale issues, project delays, and the cost of rework. Networks and platforms. A local area network connects people and devices within one site. A wide area network connects multiple sites. An intranet is a private internal portal for staff. An extranet is a secure connection for selected partners or suppliers. The public internet provides global connectivity and opportunities, but also cyber risks. Cloud services provide remote storage and processing that scale with demand and can reduce maintenance. Wireless and mobile. Wireless networks and handheld devices give mobile access to core applications and data. Practical uses include retail applications, hospital ward tablets, and field teams updating information in real time. Direct data capture for accuracy and speed. Optical character recognition converts images into text quickly and at low cost, although poor handwriting or low-quality scans can reduce accuracy. Optical mark recognition reads filled-in marks on forms and tests, which is fast and inexpensive, but depends on careful completion. Magnetic ink character recognition reads specially printed characters on checks with very low error rates, although the equipment is costly. Control for generating and distributing information. Build controls at input, processing, and output. At input, use authorization, range and format checks, check digits, and complete audit trails. During processing, ensure that only authorized personnel run processes and that system logs are maintained. At output, restrict information to authorized recipients and manage distribution lists. Security of confidential information. Protect confidentiality with passwords, user roles, and a formal security policy. Train users to recognize risks. Encrypt sensitive data during transmission and in storage, and use firewalls and device hygiene to reduce eavesdropping, human error, and malware threats. Exam and practice takeaways. Remember the qualities of good information, key sources, cost, benefit thinking, networks and cloud basics, mobile capture methods, and strong controls and security. These foundations support better performance management decisions. Welcome back. In this session, we are covering Chapter 3 of Performance Management, Information Systems and Data Analytics. In less than 5 minutes, you will learn how organizations use systems and data to make smarter decisions. Learning objectives. By the end of this video, you will understand the role of information systems, the main types of systems, the 5 characteristics of big data, the benefits and risks of analytics, and what this all means for management accountants. Levels of information needs. Different levels of management need different types of information. At the strategic level, senior managers need forecasts, competitor data, and external information for long-term planning. At the management level, middle managers use budgets, productivity reports, and labor data to control performance. At the operational level, staff rely on detailed daily transactions to keep the business running. Types of information systems. To provide this information, organizations rely on several systems. Transaction processing systems, management information systems, decision support systems, executive information systems, enterprise resource planning systems, and customer relationship management systems. Transaction processing systems. Transaction processing systems handle day-to-day business transactions. Examples include the Amazon checkout system, which manages orders, payments, and refunds. Automated teller machines, which process withdrawals, deposits, and balance checks. and the Uber app payment system, which handles ride bookings and customer payments. Management information systems. Management information systems convert raw data into summarized reports for managers. Examples include SAP Business One reports that summarize sales and finance, Oracle NetSuite dashboards, which support small and medium enterprises, and hotel property management system reports, which show occupancy, revenue, and performance. Decision support systems. Decision support systems help managers make semi-structured or unstructured decisions using data models. Examples include Tableau or Power BI for scenario analysis and what-if planning, Google Analytics, which supports marketing decisions with customer insights, and healthcare decision support systems, which predict patient treatment outcomes. Executive information systems. Executive information systems provide strategic dashboards and key performance indicators for senior executives. Examples include SAP Executive Dashboards with real-time financial data, IBM Cognos Analytics, which helps executives review overall performance, and ProfitSword Business Intelligence, widely used in hospitality finance for high-level property performance reporting. Enterprise resource planning systems. Enterprise resource planning systems integrate core processes such as finance, human resources, supply chain, and operations into one database. Examples include SAP S/4HANA, Oracle Fusion ERP, and Microsoft Dynamics 365, all of which deliver real-time, organization-wide information. Customer relationship management systems. Customer relationship management systems manage customer data, sales, service, and marketing activities. Examples include Salesforce, the most popular CRM worldwide, HubSpot CRM, which is widely used for its marketing integration, and Zoho CRM, which provides cost-effective solutions for small businesses. Big data characteristics. Big data is defined by 5 characteristics, often called the 5 V's. Volume, which means very large data sets. Velocity, which refers to the speed of data creation and processing. Variety, which means data comes in many forms such as numbers, text, images, and video. Veracity, which refers to the reliability and quality of the data. And value, which is the business benefit created from analyzing the data. Companies like Facebook, Amazon, and Walmart demonstrate all of these characteristics every day. Big data benefits. The benefits of big data are powerful. It supports faster and more accurate decisions. It drives innovation and provides competitive advantage. It improves productivity and resource allocation. For example, UPS saved millions of dollars in fuel costs by analyzing vehicle and driver data to optimize delivery routes. Healthcare providers use big data to improve treatment outcomes, and sports teams use analytics to improve performance. Big data risks. But there are also risks. Many organizations lack skilled staff to manage and interpret complex data. There are serious risks of data leaks and cybersecurity failures. There are issues around data protection and ethical use of personal information. And there is the danger of information overload, where too much data creates confusion rather than clarity. In the exam, always show awareness of both the benefits and the risks. Big data management and analytics. To handle big data, organizations combine traditional data warehouses with new tools such as Hadoop and other open-source frameworks. These systems process massive data sets and reveal patterns, correlations, and insights. The goal is to turn data into decisions that shape competitive strategies. Implications for management accountants. For management accountants, enterprise and data systems change the role. Less time is spent on routine transaction processing. Instead, accountants focus on interpreting information, supporting managers, and providing insights for decision-making. This shift makes accountants more valuable as strategic partners. Exam takeaways. Here are the exam takeaways from Chapter 3. First, be able to define each of the 6 types of information systems. Second, remember the 5 V's of big data. Third, explain both the benefits and the risks of analytics. And finally, always link data analytics back to performance management decisions. That completes Chapter 3. Welcome back. In this video, we cover Chapter 4 of Performance Management, Specialist Cost and Management Accounting Techniques. In around 6 minutes, you will learn 5 powerful costing methods that examiners frequently test. Each one gives managers a different way to understand costs and make better decisions. Objectives. By the end, you will understand activity-based costing, target costing, life cycle costing, throughput accounting, and environmental costing. You will also learn their advantages, limitations, and why examiners often use these techniques in scenario questions. Activity-based costing. Traditional costing spreads overheads across products using units, labor hours, or machine hours. But in modern businesses with automation, this often produces distorted product costs. Activity-based costing, or ABC, recognizes that activities consume resources, and products consume those activities. It therefore assigns costs using cost drivers such as the number of setups, the number of purchase orders, or inspection hours. This makes ABC more accurate when overheads are high and products are diverse. ABC example. Imagine 2 products. One is simple, one is complex. Both take the same labor hours, but the complex product requires more machine setups and inspections. Under traditional costing, both products may appear equally profitable. Under ABC, the complex product absorbs more overhead, giving managers a clearer picture. The benefits of ABC include more accurate product costing, better pricing decisions, identifying non-value-added activities, and supporting process improvement. In the exam, look out for scenarios where traditional absorption costing makes one product look profitable while ABC reveals it is actually loss-making. Target costing. Target costing is the opposite of cost-plus pricing. Instead of adding a margin to cost, it starts with a market price. Subtract the required profit margin, and you are left with a maximum allowable cost, the target cost. Formula-wise, target cost equals target price less target profit. This approach is especially useful in competitive markets where customers set the price, such as smartphones or consumer electronics. Target costing challenges. In practice, target costing is harder to apply in service industries where many costs are outside management's control, like wages or rent. If the estimated actual cost is higher than the target cost, managers face a cost gap. To close the gap, they may use value engineering, redesigning the product to deliver the same function at lower cost. They may also improve processes to reduce waste, or negotiate better terms with suppliers. In the exam, always mention that target costing encourages continuous cost reduction and cross-functional teamwork. Life cycle costing. Life cycle costing takes a long-term perspective. Instead of focusing only on production, it considers every stage of the product's life: research and development, design, production, marketing, service, and final disposal. This approach prevents short-term thinking, where managers focus on immediate profit but ignore long-term costs. It shows how early design decisions, such as material choice or durability, can impact costs and profits over many years. Life cycle benefits. Life cycle costing is especially valuable for industries with long-life products, such as aircraft, cars, or software. For example, a jet engine may be sold at break-even, but profits come from long-term maintenance contracts. By capturing all revenues and costs over the product's life, managers make better investment decisions. In exams, always link life cycle costing to sustainability, product planning, and the importance of early-stage decisions. Throughput accounting. Throughput accounting is based on the theory of constraints. It focuses on maximizing throughput, which is defined as sales revenue minus direct material cost. The idea is that only direct materials are truly variable in the short term. Labor and overheads are treated as fixed. Throughput accounting highlights bottlenecks, resources that limit total output, such as a single machine or skilled workers. The key metric is the throughput accounting ratio, or TPAR. Formula: TPAR equals return per factory hour divided by cost per factory hour. TPAR in practice. If the ratio is above 1, the product adds value because it earns more than it costs to run the factory. If the ratio is below 1, the product destroys value. To improve TPAR, managers can increase selling prices, reduce material costs, or improve efficiency at the bottleneck. In exam questions with multiple products and a bottleneck constraint, prioritize products with the highest return per factory hour, not just the highest overall contribution. Environmental costing. Finally, Environmental management accounting recognizes that businesses face rising costs from waste, pollution, and regulatory compliance. There are three main methods. Input-output analysis, which compares material inputs with outputs to identify waste. Flow cost accounting, which traces energy and material flows and assigns them a cost. And environmental activity-based costing, which applies ABC logic to pollution-causing activities, highlighting which processes generate the most environmental cost. This information helps businesses reduce waste, improve sustainability, and meet regulatory standards. Exam takeaways. To recap, activity-based costing improves accuracy in complex environments. Target costing links price, profit, and cost, encouraging value engineering. Lifecycle costing avoids short-termism and supports long-term decisions. Throughput accounting focuses on bottlenecks and the TPAR ratio. And environmental accounting highlights sustainability and waste management. Examiners often test these techniques in application scenarios, so always explain the concept, apply the formula if given data, and evaluate the benefits and limitations. Welcome back to ACCA Wiz. In today's session, we're covering Cost Volume Profit Analysis, or CVP. This chapter is a cornerstone of performance management. It connects costs, sales volume, and profit, and shows us how to plan for break-even, target profits, and risk. Let's begin. Learning objectives. Before we dive in, here are our learning objectives for this session. By the end of this video, you will be able to understand what CVP analysis is and its assumptions. Calculate and interpret the break-even point for a single product. Draw and explain the three main charts: basic break-even, contribution break-even, and profit volume. Apply CVP to multi-product situations using the weighted contribution to sales ratio. Work out sales needed to reach a target profit. Assess the margin of safety. And recognize the limitations of CVP. Break-even analysis. CVP analysis explains how costs, volume, and profit move together. We'll start with a single product, then expand to multi-product scenarios, and finally discuss the limitations. Single product break-even. Let's take an example. Selling price equals $50. Variable cost equals $30. Contribution equals $20 per unit. Fixed costs equals $20,000. Break-even units equals fixed costs divided by contribution equals 20,000 divided by 20 is equal to 1,000 units. So, if the business sells 1,000 units, it covers all costs but makes no profit. If it sells 1,700 units, profit equals 1,700 times 20, less 20,000 equals $14,000. This simple example will be carried through all our charts. Basic break-even chart. Here's the classic break-even chart. The sales revenue line rises from zero. The total cost line starts at $20,000, the fixed cost. The point where they meet is the break-even point, 1,000 units. Below BEP, the company is in loss. Above BEP, it is in profit. With forecast sales of 1,700 units, the profit area is highlighted. The gap between forecast and break-even sales is the margin of safety, which we'll revisit later. Contribution break-even chart. This chart builds on the first one. We've added a variable cost line. That means the gap between the sales line and variable cost line is the contribution. From contribution, we deduct fixed costs. The remainder is profit. This chart is great for visualizing how contribution grows as sales increase. Profit volume chart. Next is the profit volume chart. Instead of plotting costs and sales, this shows profit and loss directly. At zero sales, the business is at a loss of $20,000, the fixed costs. As sales increase, profit rises in a straight line. At 1,000 units, the line crosses zero, the break-even point. At 1,700 units, profit is $14,000. This chart is powerful because you can instantly see the relationship between sales and profit. Multi-product break-even. In real life, most companies sell more than one product. The issue, each product has a different contribution, so you can't just divide fixed costs by one product's contribution. Solution: use a weighted average contribution to sales ratio. Example: product A makes up 60% of sales. Product B makes up 40%. We calculate each contribution ratio, weight them, and then use the average to find break-even revenue. Important: this only works if the sales mix remains constant. If customers switch preferences, the break-even point changes. Target profit for multiple products. Now let's extend the idea to target profit. Formula: required revenue equals fixed costs plus target profit divided by weighted contribution to sales ratio. For example, fixed costs equals $20,000. Target profit equals $10,000. Weighted contribution to sales ratio equals 40%. Required revenue equals $20,000 plus $10,000 divided by 0.40 equals $75,000. This helps managers set sales targets to hit profit goals. Margin of safety. Margin of safety shows how much sales can fall before the business goes into loss. Formula: margin of safety equals budgeted sales less break-even sales divided by budgeted sales. In our example, 1,700 minus 1,000 divided by 1,700 equals 41%. This means sales could drop by 41% before losses occur. The higher the margin of safety, the lower the risk. It's a great indicator of stability. Limitations of CVP. CVP is simple, but it comes with limitations. It assumes costs and revenues are perfectly linear. It assumes all costs can be split cleanly into fixed and variable. It assumes the sales mix doesn't change. It ignores inflation, demand shifts, and capacity limits. So while CVP is a powerful planning tool, managers should combine it with other techniques for real-world decisions. Exam takeaways. Before we wrap up, let's recap the key takeaways. Memorize the formulas: break-even point, margin of safety, contribution to sales ratio, target profit. Be confident with the charts. Understand and interpret all four. Always discuss limitations in written questions. If you do these three, CVP becomes an easy win topic in exams. That's the end of Chapter 5, Cost Volume Profit Analysis. Welcome back. In this section, we'll cover Chapter 6 of Performance Management, Planning with Limiting Factors. This is one of the most practical topics because businesses always face resource constraints. By the end of this video, you will know exactly how to approach these problems in the exam. Why this chapter matters: every business has limited resources such as labor hours, machine time, raw materials, or even finance. Managers must plan how to make the best use of these constraints to maximize contribution. This chapter is linked to earlier topics like cost volume profit analysis, throughput accounting, and later to relevant costing. Examiners like this area because it tests your ability to apply logic and structure under pressure. One limiting factor: the 5 steps. If there is only one limiting factor, we solve it using key factor analysis. Step 1. Identify the scarce resource. Step 2. Calculate contribution per unit for each product. Step 3. Calculate contribution per unit of the scarce resource, for example, contribution per labor hour. Step 4. Rank the products in order of their contribution per scarce resource. Step 5. Allocate the scarce resource following this ranking and calculate the maximum total contribution. Ranking example. Here's a simple example. We have 3 products. If we look at contribution per unit, product B seems the best. But when we take into account labor hours, product B still performs best, followed by A and then C. This ranking ensures that the scarce resource, labor in this case, is used in the most profitable way. Exam tip: always show your ranking table clearly, and if the question includes minimum production requirements, make sure you respect those before ranking the rest. Linear programming overview. Sometimes there is more than one limiting factor. For example, both labor hours and machine time may be restricted. In that case, key factor analysis is not enough and we need linear programming. Linear programming allows us to find the optimal product mix when there are 2 or more constraints. In the exam, questions are limited to 2 variables, which means you can solve them graphically. Linear programming steps. The steps are straightforward. Define the decision variables, usually X and Y for 2 products. Write the objective function. For example, maximize contribution equals 5X plus 6Y. Formulate the constraints such as labor, machine, and demand limits. Plot these constraints on a graph to show the feasible region. Find the optimal point where contribution is maximized. Finally, Answer the question by calculating the maximum contribution or profit. Feasible region graph. Here's what the graph looks like. The blue line represents the labor constraint and the green line represents the machine constraint. The shaded gray area is the feasible region. This is where all constraints are satisfied. The optimal solution is usually at the corner point where two constraints intersect. In this example, the optimum is at 40 units of product X and 20 units of product Y. That combination maximizes contribution. Slack. Slack is a very important concept. Slack means unused capacity of a resource. If a resource is fully used up in the optimal solution, it is called a critical constraint and has zero slack. If a resource is not fully used, then it is slack and is not limiting the solution. In exams, always check if a constraint has slack because this determines whether its shadow price is zero or not. Shadow prices. Shadow prices, also known as dual prices, show how much extra contribution could be earned if you had one more unit of a scarce resource. If a resource is critical, its shadow price will be positive. If a resource has slack, its shadow price will be zero because having more of it does not improve the solution. Shadow prices are important because they tell managers the maximum premium they should be willing to pay for extra resources such as overtime labor or rented machine time. Shadow price illustration. Here's an illustration. Originally, the labor constraint was binding at 100 hours, giving an optimum of 40 units of X and 20 units of Y with a total contribution of 320. When the labor constraint is relaxed to 120 hours, the feasible region expands and the new optimal point shifts to 53 units of X and 13 units of Y. At this new point, the contribution rises to about 347, which is an increase of around 27. Since this increase came from 20 extra units of labor, the shadow price is about 1.33 per unit of labor. This tells managers the maximum premium they should be willing to pay for one more unit of that resource. Assumptions and discussion. It is important to remember the assumptions in limiting factor analysis. Contribution per unit is assumed constant. Fixed costs are ignored in the short term. Products are independent, and sales mix is assumed constant. The objective is only to maximize contribution. These assumptions make the technique simple, but they also limit its accuracy in the real world. Examiners like you to discuss these aspects in written parts of the exam. Exam takeaways. To recap, use key factor analysis when there is one limiting factor. Use linear programming when there are two or more limiting factors. Always check for slack and calculate shadow prices for critical resources. State the assumptions and limitations in your exam answers to earn professional marks. Welcome back to ACCA Wiz. In this video, we're covering Chapter 7, Pricing from the Performance Management paper. Let's break it down into simple concepts with examples so you can master this chapter for your exams. Learning objectives. By the end of this session, you'll be able to understand what affects pricing decisions. Work with price elasticity of demand. Use demand and cost equations. Find the optimum selling price using marginal revenue equals marginal cost. Decide when to expand sales. And apply different pricing strategies like cost plus, penetration, and skimming. We'll also solve worked examples along the way. Introduction to pricing. Pricing is at the heart of profit. Remember, profit equals selling price less cost. The price you set doesn't just recover costs. It directly affects demand and sales volume. Market structures. Different markets give businesses different levels of power to set prices. In perfect competition, firms are price takers. In a monopoly, one seller can set prices freely. In an oligopoly, a few firms dominate, so each one carefully watches the others. And in monopolistic competition, products are differentiated, so companies have some control over pricing. Price elasticity of demand. Price elasticity of demand tells us how sensitive customers are to price changes. If price elasticity of demand is greater than 1, demand is elastic. Customers react strongly to price changes. If price elasticity of demand is less than 1, demand is inelastic. Customers are less responsive. Businesses use this to decide whether to raise or lower prices for revenue maximization. Price elasticity of demand curve. Here's the demand curve. Notice the elastic region at higher prices. Small price cuts create big demand increases. In the inelastic region at lower prices, Price cuts don't add much demand. Price elasticity of demand example. For example, if the price drops from $10 to $9, demand rises from 100 units to 120. Price elasticity of demand equals percentage change in quantity, that is 20%, divided by percentage change in price, that is minus 10%, equals minus 2. This means demand is elastic, so lowering the price increases revenue. Straight line demand equation. We can also model demand using an equation. Price equals A, B times quantity. Here, A is the maximum price when demand is 0, and B is how much price drops per extra unit sold. This makes demand predictable. Total cost function. Total cost equals fixed costs plus variable costs. If discounts apply, the function becomes stepped. For example, up to 5,000 units. Total cost equals 250,000 plus 6x. Above 5,000 units. Total cost equals 250,000 plus 5.4x. So cost change as volume grows. Optimum price and quantity. Profit is maximized where marginal revenue equals marginal cost. Before this point, producing more adds profit. After this point, producing more reduces profit. Marginal revenue and marginal cost chart. So here, the orange line shows marginal revenue and the blue line shows marginal cost. The intersection point is the optimum. The output is 20 units, where marginal revenue equals marginal cost at $20. But remember, the selling price is not taken from marginal revenue or marginal cost. It comes from the demand curve. At 20 units, the demand curve tells us customers are willing to pay $60 per unit. That's why the optimum combination is quantity equals 20 units, price equals $60, with marginal revenue and marginal cost balanced at $20. Optimum price example. Let's solve it. Demand equation. Price equals 100 less 2 times quantity. Total revenue equals 100 times quantity less 2 times quantity squared. Marginal revenue equals 100 less 4 times quantity. If marginal cost equals 20, then setting marginal revenue equal to marginal cost gives quantity equals 20, price equals 60. So the optimum is 20 units at $60 each. Increasing sales. When considering expansion, check incremental revenues and costs. Accept if extra contribution is greater than extra costs. Reject if extra fixed costs outweigh the contribution. Approaches to pricing. There are 3 main approaches. Cost-based pricing. Add a profit margin to costs. Demand-based pricing. Set price based on customer willingness to pay. Competition-based pricing. Match or position against rivals. Pricing strategies. Some common strategies include cost plus, simple, ensures cost recovery. Skimming, start high, then lower over time. Penetration, start low to gain market share. Complementary, price main product low but charge for extras. Product line, different price levels across a product range. Volume discounting, lower price for bulk. Price discrimination, different prices for different groups. Relevant cost pricing, for special orders, based on incremental costs. Strategy comparison. Here's a comparison. Cost plus works well in stable markets. Skimming is for unique new products. Penetration works in competitive markets. Complementary suits link products like printers and cartridges. Cost plus example. If cost per unit is $50 and we want a 25% margin, price equals 50 times 1.25 equals $62.50. Relevant cost example. For a one-off order of 1,000 units, variable cost equals $15. Offer price equals $20. Contribution equals $5 per unit, $5,000 total. Since it adds contribution, accept the order. Chapter summary. To sum up, pricing decisions shape profitability. Market structure determines how much control firms have. Elasticity and demand equations help set prices wisely. The optimum price is always where marginal revenue equals marginal cost. And the right strategy depends on market context and objectives. That's Chapter 7, Pricing. Welcome to the ACCA Performance Management, Chapter 8, Relevant Costing. In this session, we will break down relevant costing step by step, with examples, examination tips, and decision rules. Let's dive in. Learning objectives. By the end of this lecture, you will be able to explain what relevant costing is, distinguish relevant costs from irrelevant costs, apply the idea of opportunity cost, Calculate relevant costs for materials, labor, overheads, and assets. Apply relevant costing to one-off contracts, make-or-buy decisions, shutdowns, and further processing. Spot examination traps and apply clear decision rules. Introduction. Relevant costing focuses on the costs and revenues that change because of a decision. The rule is simple. Relevant costs are future costs, incremental costs, and cash flows. We ignore sunk costs, committed costs, and any non-cash charges such as depreciation. Always focus only on what will actually change with the decision. Relevant versus irrelevant costs. Relevant costs are future costs, incremental costs, and actual cash flows. Irrelevant costs include sunk costs, which are already incurred, committed costs, which are unavoidable, non-cash items such as depreciation, and absorbed overheads. Here is your first examination tip. If the cost does not change, it does not count. Opportunity costs. Sunk costs are in the past and are irrelevant. Opportunity costs, however, are always relevant. They represent the value of the next best alternative foregone. For example, using labor on Project A means losing contribution from Project B. Or, using a machine on one job means giving up its rental income elsewhere. Always include opportunity cost in your calculation. Relevant cost of materials. Materials are a classic examination topic. If the material must be purchased, the relevant cost is the purchase price. If material is in stock but will be replaced, the relevant cost is the replacement price. If material is in stock and will not be replaced, the relevant cost is the resale value or scrap value foregone. If the material is scarce, include the lost contribution from the best alternative use. Example, 500 kilograms in stock. Replacement cost is $10 per kilogram. Resale value is $7 per kilogram. The relevant cost is $10 multiplied by 500, equal to $5,000. The replacement cost dominates. Relevant cost of labor. For labor, if workers are idle, there may be no cost unless additional payments are required. If there is spare capacity, only the variable cost is relevant. If workers are fully employed, add the lost contribution from displaced work. If overtime or temporary staff are required, include those incremental costs. Examination tip. Always state whether labor is idle, at full capacity, or on overtime. Relevant costs of overheads. Overheads. Variable overheads are relevant. Fixed overheads are relevant only if they are avoidable. Apportioned overheads are irrelevant. This is a common examination trap. Never include absorbed overheads when calculating relevant costs. Relevant costs of non-current assets. For assets, depreciation and book value are irrelevant. If the asset has a resale value, use that as the relevant cost. If the asset could be rented out, the rental income foregone is the opportunity cost. If a new purchase is required, the full purchase price is relevant. Rule: always think in terms of cash flows and alternatives. One-off contracts. For special orders, the decision is based on relevant cost equals variable costs plus incremental fixed costs. Ignore sunk costs and absorbed overheads. If the contract price is above the relevant cost, it is worth considering. Examination twist. Even if the price is below the full cost, as long as it is above the relevant cost, it may still be acceptable in the short term. Make or buy. General. Make or buy decisions compare the internal relevant cost of making versus the supplier cost of buying. Choose whichever option is cheaper, but do not forget qualitative factors such as quality, reliability, and long-term implications. Make or buy. No limiting factor. If there is no limiting factor, the decision is simple. Just compare the make cost with the buy cost and pick the lower one. Example: if making costs $8,000 and supplier price is $9,000, making is cheaper. Make or buy. With limiting factor. When a limiting factor exists, such as scarce labor hours, you must rank by contribution per unit of the scarce resource. Then allocate the scarce resource to maximize contribution. This is a favorite Kaplan examination style. Contribution per resource unit. Qualitative issues in make or buy. Do not forget the softer side. Quality control. Supplier reliability. Strategic dependence. flexibility, and the long-term impact on skills and costs. These points often appear as discussion marks in examinations. Outsourcing, pros and cons. Outsourcing decisions are linked to make or buy. Pros include access to specialist skills, lower costs, and more focus on core business. Cons include dependency on the supplier, less control over quality, and hidden or contractual costs. Always weigh both the financial and the strategic implications. Shutdown decisions. Shutdown decisions compare contribution lost versus avoidable costs saved. Rule: shut down if avoidable costs saved are greater than contribution lost. Example: contribution is $10,000, savings are $12,000, therefore, shut down. Remember, apportioned fixed costs that cannot be avoided are irrelevant. Further processing of joint products. In joint products, costs up to the split-off point are sunk. The decision to process further depends only on incremental revenue versus incremental cost. If incremental revenue is greater than incremental cost, process further. If not, sell it split-off. Never apportion joint costs into this decision. Examination tips and pitfalls. Key tips: never include sunk costs. Always check for hidden opportunity costs. Use tabular formats for clarity. Clearly state your assumptions. And remember, the examiner wants to see logical, decision-focused reasoning, not financial accounting. To recap, relevant costs are future costs, incremental costs, and cash flows. Irrelevant costs are sunk costs, committed costs, absorbed costs, and non-cash items. We applied these rules to materials, labor, overheads, assets, one-off contracts, make-or-buy decisions, outsourcing, shutdowns, and further processing. That is the essence of relevant costing, a vital decision-making tool for the performance management paper. Imagine you are a manager who has to make $1 million decision, but the future is uncertain. Do you play it safe? Do you take the risk? Or do you find a smarter way? Welcome to Chapter 9 of Performance Management, Risk and Uncertainty. By the end of this session, you will know exactly how accountants use research, probabilities, and decision models to reduce uncertainty and make better business choices. Stay with me until the end, because we will also uncover how much information is truly worth paying for. In this lecture, you will learn to suggest research techniques that reduce uncertainty, understand simulation, expected values, and sensitivity analysis, apply decision-making methods such as max-I-max, maximin, and minimax regret, learn how to draw and interpret decision trees, and calculate the value of both perfect information and imperfect information. Every one of these techniques is examinable, so pay close attention. Let us begin with the difference between risk and uncertainty. Risk means we know the possible outcomes and we can assign probabilities to them. For example, there is a 60% chance of finding oil. Uncertainty means we know the possible outcomes, but we cannot assign probabilities. Imagine drilling at a brand new site with no data at all. The key difference is whether probabilities are available. Where does risk come from? It comes from variability in returns, from whether managers are risk-seeking or risk-averse, and from the balance between upside potential and downside losses. Recognizing the source of risk is the first step in managing it. One way to reduce uncertainty is through research. Research can be focus groups, desk research, or field research. Focus groups are small group discussions. They provide fast qualitative insights and are useful for testing ideas, but the downside is bias and small sample size. Think of them as a quick opinion check, not as hard numbers. Desk research uses existing data such as census reports or competitor reports. It is fast and inexpensive, but the information may be outdated or not specific to your situation. Field research collects new data through surveys or direct observation. It is accurate and specific, but it is also costly and time-consuming. Now let us move to analytical techniques. Sensitivity analysis asks how much a variable needs to change before our decision changes. For example, if outsourcing is only cheaper when the supplier price stays below a certain level, sensitivity analysis shows us that threshold. It is simple and highlights key risks, but it only looks at one variable at a time. Simulation allows us to test multiple scenarios at once. A film company can simulate ticket sales, refreshment sales, and costs to predict profitability. It is powerful, but it depends on assumptions and requires software. Expected value is calculated by multiplying the probability of each outcome by its payoff and then adding them up. For example, if sales could be $1,200 with 60% probability or $800 with 40% probability, the expected value is $1,040. It is objective and useful for repeated decisions, but it does not reflect human attitudes to risk. Payoff tables summarize profits or losses under different demand scenarios. For example, if a salad bar chooses whether to prepare 40 or 70 salads, the table shows how much profit or loss is made under low, medium, or high demand. This connects directly to 3 decision rules. The max-I-max rule is for optimists. It means choosing the option with the maximum possible payoff. In our salad example, that would mean producing 70 salads because the highest possible profit is $140. The maximum rule is for pessimists. It looks at the worst-case outcomes and chooses the option with the best of those. Hey, making 40 salads gives the best minimum payoff of $80 compared to a loss of 70. The minimax regret rule is about avoiding regret. We create a regret table that shows how much we lose by not choosing the best option. Then we select the option with the lowest maximum regret. This method is useful for managers who want to minimize missed opportunities. Decision trees are diagrams that map out choices and outcomes. Squares represent decision nodes, circles represent chance nodes. The process is to build the tree, assign probabilities, calculate expected values, and then select the highest expected value option. The Duke of York cinema case is a good example. They were uncertain about demand and refreshment sales. By creating a decision tree and calculating expected values, they could identify the best strategy. In the exam, always label nodes clearly and show calculations step by step. Consider the oil drilling example. If the company drills, there is a 40% chance of success with $30,000 profit and a 60% chance of failure with a $10,000 loss. The expected value works out to $10,000, which is higher than the expected value of doing nothing, which is 0. The rational choice is to drill. Now let us talk about the value of information. Perfect information tells us the future with certainty. Its value is calculated as expected value with information minus expected value without information. In the salad example, perfect information adds $28 a day. That means $28 is the maximum the business should pay for such information. In reality, most forecasts are imperfect. A geologist might be right 80% of the time. If the expected value of imperfect information is $6,698 but the report costs $7,000, then it is not worth paying for. Let us recap. Research reduces uncertainty but never removes it completely. Simulation provides insight but not final decisions. Expected value is useful for repeated decisions but ignores human risk attitudes. Max-I-max, maximin, and minimax regret are applied when probabilities are unknown. Decision trees are excellent for multi-stage problems. And information has value only if its benefit is greater than its cost. Welcome to Chapter 10 of Performance Management, Budgeting. Budgets are one of the most important tools in management accounting. They link strategy with operations and help organizations plan, control, communicate, and evaluate performance. By the end of this lecture, you will be able to understand budgeting and the performance hierarchy, explain the main systems, identify sources of information, evaluate budget types, prepare flexed, rolling and activity-based budgets, explain beyond budgeting, discuss target difficulty, participation and controllability, describe the challenges in changing systems, show how budgets handle uncertainty, and consider ethical and sustainability issues. Budgets fit into the performance hierarchy. At the strategic level, they reflect long-term objectives. At the tactical level, they allocate resources to projects and departments. At the operational level, they guide daily action. Without budgets, the link between strategy and operations is often broken. Budgeting serves several purposes. Planning forces managers to think ahead instead of reacting. Control allows results to be compared with plans and corrective action taken. Communication ensures expectations are shared up and down the organization. Coordination aligns all departments to a common corporate goal. Evaluation allows managers to be judged fairly on revenues and costs within their control. There are many systems. Top-down is led by senior management, while bottom-up involves junior managers. Incremental use is last year's budget plus adjustments. Zero-based starts from scratch. Rolling updates the budget continuously. Activity-based uses cost drivers rather than departments. Feed-forward control anticipates problems before they occur. Selecting a system depends on factors such as the nature of the organization, its environment, the availability of data, and management culture. Incremental works well in stable organizations. Zero-based suits dynamic environments where costs need justification. Rolling budgets are effective in fast-changing conditions. Activity-based is accurate in complex service or manufacturing settings. Top-down is appropriate for strong central control, while bottom-up works in participative cultures. Feed-forward is useful when early correction is needed. Top-down budgeting ensures strategic alignment and speed, but can demotivate staff. Bottom-up provides realism and ownership, but may lead to budgetary slack and is time-consuming. In practice, a mixture is often used. Incremental budgeting is easy to prepare but can lock in inefficiency. Zero-based challenges every cost, improving efficiency but requiring effort. For example, under zero-based, a marketing manager must justify each campaign rather than simply repeating last year's spend. Rolling budgets maintain a 12-month horizon by adding new months as each ends. They keep budgets relevant but require ongoing work. Activity-based budgets allocate costs to activities such as purchase orders, giving accuracy but needing detailed information. Feed-forward control is predictive. For example, if a forecast shows demand will fall, managers can cut production in advance. This avoids waste and is a proactive form of control. Budget information comes from internal sources such as past results and departmental forecasts, and external sources such as competitors and market research. Problems include bias, inaccuracy, and outdated figures. Reliable information is essential. Budget types also vary. Fixed budgets are easy but poor for evaluation because they assume one activity level. Flexible budgets adjust to actual activity, providing fairer comparison. Master budgets consolidate all functional budgets into one. Functional budgets focus on departments. Incremental, rolling, zero-based, and activity-based systems each have their own strengths and limitations. Flexed budgets are especially important. Suppose 1,000 units were budgeted but 1,200 were produced. A flexed budget adjusts sales and variable costs to 1,200 units. This ensures that variances reflect real performance, not differences in volume. Rolling budgets extend the horizon and ensure management always looks ahead. Activity-based budgets link costs to activities such as machine setups, producing a more accurate picture of resource use. Budgets also affect behavior. They can motivate, but they can also lead to slack, manipulation, or short-termism. Hopwood identified 3 styles. The budget-constrained style emphasizes meeting short-term budgets. The profit-conscious style balances budgets with longer-term profit. The non-accounting style focuses on wider, non-financial measures. These styles highlight the behavioral dimension in budgeting. Target difficulty is also key. Easy targets encourage little effort. Challenging but achievable targets are motivating. Unrealistic targets frustrate and demotivate staff. Always consider whether the target is at the right level. Participation in budgeting gives managers ownership and improves realism. However, it is slower and can lead to slack if managers deliberately understate revenues or overstate costs. The principle of controllability means managers should only be judged on what they influence. For example, a production manager should not be assessed on sales revenue. Fairness in evaluation improves motivation. Budgets must also consider external factors. The pestle model highlights political, economic, social, technological, environmental, and legal influences. For example, tax changes, inflation, automation, or new environmental laws may affect budgets. Beyond budgeting is a modern model that challenges traditional systems. It is built on 6 principles: setting relative rather than fixed targets, linking rewards to performance against peers, making planning adaptive and continuous, replacing rigid controls with key performance indicators, allocating resources flexibly, and coordinating through shared values rather than fixed numbers. Benefits include flexibility and innovation, but implementation is difficult. Changing budgetary systems is challenging. Barriers include organizational culture, resistance to change, costs, and training needs. For example, moving from incremental to activity-based requires new systems and detailed data. Budgets also help in managing uncertainty. Flexible budgets adjust to actual activity. Rolling budgets keep forecasts current. Scenario planning prepares for different possible futures. Forecasting and sensitivity analysis test assumptions to show how results change with key variables. Ethical and sustainability issues are increasingly important. Ethically, budgets must be prepared honestly, without manipulation. Sustainability means including social and environmental goals such as reducing emissions or supporting communities. Many organizations now link budgets to corporate responsibility. To recap, budgets link strategy to operations through planning and control. They serve multiple purposes including planning, communication, coordination, and evaluation. Different systems suit different contexts. Flexed, rolling, and activity-based budgets improve accuracy. Behavioral and ethical aspects must always be considered. Beyond budgeting provides flexibility, but has challenges. Mastering these ideas will allow you to confidently handle budgeting questions. Hey everyone, welcome back to ACCA Wiz. In this lesson, we're covering Chapter 11, Quantitative Techniques, one of the most practical areas in performance management. These techniques help managers turn raw data into smart business decisions. Chapter 11 focuses on the analytical tools used to measure, predict, and improve performance, from cost estimation to forecasting trends. Learning objectives. Here's what you'll master. Separating fixed and variable costs with the high or low method. Applying correlation, regression, and time series analysis. Understanding Wright's law and the learning curve. Using both algebraic and tabular approaches. And learning how to use interpolation and extrapolation sensibly. Finally, we'll review their pros and cons. Overview of quantitative techniques. Quantitative techniques mean using numerical data for planning and forecasting. The 4 main tools are high-low analysis, regression and correlation, time series analysis, and the learning curve model. Together, they allow businesses to interpret costs, trends, and efficiency improvements. High-low method purpose and formula. The high-low method splits a mixed cost into its fixed and variable parts. We take 2 data points, the highest and the lowest levels of activity, and calculate. Total cost equals fixed cost plus variable cost times activity level. It's quick and ideal when only minimal data is available. Steps in high-low analysis. First, identify the highest and lowest activity levels. Second, compute variable cost per unit equals change in cost divided by change in activity. Third, derive fixed cost equals total cost, less variable cost times activity. Finally, use y equals a plus bx to forecast costs for any activity level. It's a simple but powerful first step in cost analysis. Advantages and limitations. The high-low method is fast and easy to apply. But because it uses only 2 points, it can be distorted by abnormal data and assumes that activity is the only factor driving cost. Learning curve and Wright's law. Now, let's move to the learning curve. Wright's law says, as cumulative output doubles, the average time per unit falls by a fixed percentage. This happens because people and processes improve with experience. Formula: y equals a times x to the power of b, where b equals the log of r over the log of 2, and r is the learning rate. A equals time for first unit and x equals cumulative units. So an 80% learning rate means each time output doubles, average time drops to 80% of the previous level. Algebraic and tabular approaches. 2 ways to apply it. The algebraic approach uses the formula for direct calculation, great for fast exam work. The tabular approach lists each doubling of output to show how average and total time change. Both lead to the same learning effect, but one is numeric while the other is visual. Tabular example. Here's a simple illustration. First unit takes 100 hours at an 80% learning rate. 2 units, 80 hours each. 4 units, 64 hours. 8 units, 51.2 hours. Total time increases, but average time per unit falls. That's efficiency gained through learning. Limitations of learning curves. Learning curves work mainly in labor-intensive or repetitive work. Learning stops once a steady state is reached. External factors like staff turnover or new technology can reset the curve. Steady state. The steady state is the point where no further time savings occur. This value is used for long-term forecasting and setting realistic standards. Applications of learning effect. Managers use learning analysis for labor budgeting, pricing new contracts, setting standard costs, forecasting cash flows, and tracking productivity improvement. Regression basics. Regression analysis finds the line of best fit between two variables. Equation: y equals a plus bx, where is the intercept and b is the slope. It predicts future costs or revenues and uses all data points instead of just two, making it more accurate than high or low. Linear regression explains the straight-line relationship between two variables. We write it as y equals a plus b times x. Y is the dependent variable, x is the independent variable, a is the intercept or fixed cost, and b is the slope or variable rate. B is found by comparing changes in x and y, and a equals the average of y minus b times the average of x. It helps predict costs from activity. Regression limitations. Regression assumes a straight-line relationship and can be skewed by outliers. Forecasts weaken outside the sample, and correlation never proves causation. Always support it with business judgment. Interpolation and extrapolation. Interpolation estimates values within known data, for example April sales between March and May. Extrapolation extends beyond known data, like forecasting next year's sales. Use only if the trend is stable. Correlation analysis. Correlation shows how strongly two variables move together. The coefficient are ranges from -1 to +1. Positive means they increase together. Negative means they move opposite, and 0 means no link. Scatter plots help visualize this relationship. Time series purpose and components. Time series data records values over time to forecast future behavior. It has 4 components: trend, long-term direction, seasonal, short-term patterns, cyclical, business cycles, and random, unpredictable variations. Understanding these lets managers separate consistent patterns from noise. Additive model. Used when variations are constant. Formula: y equals t plus s plus c plus r. Example: trend 100, seasonal plus 20, random -5, total 115. Here each component adds to the final value. Multiplicative model. Used when variations change proportionally with the trend. Formula: y equals t times s times c times r. If trend equals 100, seasonal equals 1.2, random equals 0.9, then y equals 108. This model fits data where seasonal effects grow as business expands. Finding seasonal variations. To calculate seasonal factors, find the moving average for trend, compare actual values to that trend, average those ratios for each season, and apply them to future forecasts. Time series pros and cons. Advantages: reveals trends and seasonality for planning. Limitations: relies on historical data and assumes patterns continue, so sudden shifts can mislead forecasts. Comparison of techniques. High-low is fast but rough. Regression is accurate but assumes linearity. Time series predicts trends but needs stable data. Learning curve shows realistic improvement but is complex. Each has a different purpose, and together they build a complete forecasting framework. Conclusions and controllability. Quantitative techniques enhance planning and control, but managers should never rely on numbers alone. Use data to support, not replace, judgment. Under the principle of controllability, assess managers only on factors they can influence, for example, production efficiency, not sales volume. Recap and key takeaways. We've seen how high or low splits costs, regression, and correlation analyze relationships, learning curve show efficiency gains, and time series predicts patterns. All help forecast costs and performance, guiding better managerial decisions. This chapter pulls all the quantitative techniques together into one view of data-driven management. Mastering them builds a solid foundation for ACCA Performance Management and your career in finance. Welcome to ACCA Performance Management Chapter 12, Advanced Variances. In this session, we will explore how to understand, calculate, and interpret advanced variances including planning and operational, mix and yield, sales mix and quantity, and fixed overheads. By the end of this lesson, you will be able to explain every major variance type, apply the formulas correctly, and understand how they affect business performance and exam success. Let's recap basic variances. This table summarizes key variances. Sales price variance equals actual price minus standard price times actual quantity. Volume variance equals actual quantity minus budgeted quantity times standard price caused by market demand or pricing. Material price and usage variances show cost or wastage differences. Labor rate and efficiency variances reflect pay rates, productivity, and idle time. Material usage variance can be split into two parts: mix variance and yield variance. Mix variance measures the impact of using a different proportion of materials than planned, while yield variance measures the efficiency of turning input into output. Together, they explain whether inefficiency came from the wrong combination of materials or from the production process itself. The formulas are simple. Total usage variance equals mix variance plus yield variance. Mix variance equals revised standard mix minus actual mix times standard price. Yield variance equals actual input minus standard input for actual output times average standard price. For example, the standard mix is 60 kilograms of material A at $2 and 40 kilograms of material B at $3. Actual usage is 50 kilograms each with 95 kilograms of output. Mix variance equals $20 adverse. Yield variance equals $12.50 adverse. Total usage variance equals $32.50 adverse. This shows that both the choice of materials and production efficiency affected the result. Next, we have sales mix and quantity variances. These show how selling products in different proportions or volumes affects total profit. Sales mix variance shows the effect of a change in sales proportions. Sales quantity variance shows the effect of a change in total units sold. Together they form the sales volume variance. The formulas are sales mix equals actual mix minus budgeted mix times total actual units times standard margin. Sales quantity equals actual total units minus budgeted total units times weighted average margin. Here is an example. The budget was 60% product A at $10 and 40% product B at $8. Actual sales were 70% A and 30% B, with 1,000 units sold. Sales mix variance equals $100 adverse. Sales quantity variance equals $92 favorable. This means total sales volume increased, but the mix shifted towards a lower margin product. Next, we look at fixed overhead variances under marginal and absorption costing. Under marginal costing, we only analyze the expenditure variance. Under absorption costing, we also analyze the volume variance, which is split into capacity and efficiency variances. This gives a deeper view of how well fixed resources were used. The formulas are fixed overhead expenditure equals actual fixed overhead minus budgeted fixed overhead. Volume variance equals standard hours for actual output minus budgeted hours times standard absorption rate. Capacity variance equals actual hours minus budgeted hours times standard rate. Efficiency variance equals standard hours minus actual hours times standard rate. Here is an example. Budgeted hours were $2,000 at $5 per hour, giving $10,000. Actual hours were 2,200. Standard hours for output were 2,100. Actual overhead was $10,400. Expenditure variance equals $400 adverse. Capacity variance equals $1,000 favorable. Efficiency variance equals $500 adverse. Therefore, volume variance equals $500 favorable. and the total variance equals $100 adverse. Now let us consider planning and operational variances. Planning variance compares the original standard with a revised standard and captures uncontrollable external changes such as inflation. Operational variance compares actual results with a revised standard and focuses on performance that management can control. Separating them ensures fair evaluation. The total price variance equals actual price minus original standard times quantity. It can be split into planning variance equals revised standard minus original standard times actual quantity. Operational variance equals actual price minus revised standard times actual quantity. For example, the original standard price is $5, the revised standard price is $6, and the actual price is $6.30. For 1,000 units, the planning variance equals $1,000 adverse, the operational variance equals $300 adverse, and the total equals $1,300 adverse. Next, let us look at idle time and waste. Idle time represents hours paid but not worked, often due to machine breakdowns. This is shown separately in labor variances. Material waste refers to using more input than planned and is included in the yield variance. Both highlight process inefficiencies. To control these issues, improve scheduling, reduce downtime, maintain equipment, and set realistic standards that allow for normal levels of waste. Variances should be investigated when they are large, unusual, strategically important, controllable by the responsible manager, or when the benefit of investigation exceeds its cost. In modern manufacturing, automation has reduced the relevance of labor variances. The focus now is on machine efficiency, downtime, and quality. Variance analysis must evolve to include these modern measures using real-time performance tracking and continuous improvement systems. There are four main types of standards. Ideal standards assume perfect conditions but can demotivate staff. Attainable standards are realistic and encourage performance. Basic standards are long-term benchmarks useful for trend analysis. Current standards reflect today's conditions and are updated frequently. When setting standards, top-down methods are fast but may cause resistance, while bottom-up methods improve accuracy and engagement. The best approach is participative standard setting, combining both accuracy and motivation. To reconcile variances to actual profit, start with budgeted profit, add sales price and sales volume variances, then subtract material, labor, and overhead variances. The result is actual profit, fully explained through variance analysis. To recap, sales volume variance splits into mix and quantity. Material usage variance splits into mix and yield. Fixed overhead volume variance splits into capacity and efficiency. Planning and operational variances separate controllable from uncontrollable factors. Together, they provide a full performance analysis framework. In conclusion, variance analysis is not just about identifying differences, it is about understanding causes and improving performance. Use mix and yield to find inefficiencies, split planning and operational results for fairness, and always set realistic attainable standards. Variances are tools for learning, not for blame. Welcome to ACCA Performance Management Chapter 13, Performance Measurement and Control. In this session, we explore how businesses judge success using both financial and non-financial performance indicators. You'll learn how to calculate and interpret key ratios, understand why short-term profit is not always the best sign of success, and see how models such as the balanced scorecard and the building block model help link daily operations to long-term strategy and sustainability. Performance measurement shows how effectively a business meets its objectives. It combines financial and non-financial information. Good control means comparing results, identifying causes, and taking action. These ideas apply in both private and public sectors, where efficiency and accountability matter equally. Financial performance indicators, or FPIs, measure profitability, efficiency, liquidity, and gearing. Profitability shows how much profit is earned from sales or capital. Efficiency measures how productively resources such as inventory and receivables are used. Liquidity checks whether short-term obligations can be met. Gearing assesses long-term risk by comparing debt with equity. Together, these ratios explain how well an organization manages money and risk. Profitability ratios include gross profit margin, operating profit margin, and return on capital employed. Gross profit margin equals gross profit divided by turnover times 100. It shows how much profit remains after direct costs. Operating profit margin equals operating profit divided by turnover times 100. It reflects control over overheads. Return on capital employed equals operating profit divided by capital employed times 100, or operating profit margin times asset turnover. ROAS indicates how efficiently long-term funds generate profit. Rising margins suggest efficiency. Falling ones may mean cost or pricing problems. Efficiency ratios measure how quickly resources turn into cash. Asset turnover equals turnover divided by capital employed. Inventory days equals inventory divided by cost of sales times 365. Receivable days equals receivables divided by sales times 365. Payable days equals payables divided by purchases times 365. High inventory or long receivable days tie up working capital. Very low figures might harm relationships or cause stockouts. Liquidity ratios assess short-term solvency. Current ratio equals current assets divided by current liabilities. Quick ratio equals current assets, inventory, divided by current liabilities. A ratio near 1.5 to 2 is healthy for most industries. Gearing equals debt divided by debt plus equity times 100. Interest cover equals operating profit divided by finance cost. High gearing increases risk but may raise returns. Strong interest cover shows safety. Ratios alone have limits. They focus on short-term results and may encourage manipulation, such as delaying expenses. They ignore non-financial factors like innovation or staff morale and rely on historic data that may not reflect the future. That's why businesses also track non-financial performance indicators, or NFPIs. NFPIs measure the operational drivers of future results. Examples include customer satisfaction, product quality, employee turnover, staff training hours, delivery reliability, and environmental performance. Financial indicators show what happened. NFPIs explain why it happened. Consistent strength in these areas usually predicts future financial success. The Balanced Scorecard by Kaplan and Norton combines both types of indicators across 4 perspectives. The financial perspective asks how value is created for shareholders. The customer perspective focuses on what customers value most. The internal process perspective looks at what the business must excel at operationally. The learning and growth perspective covers innovation, staff skills, and system improvement. Each perspective includes objectives, measures, targets, and actions, ensuring strategy turns into measurable results. It gives a balanced view but can be complex and sometimes subjective. For instance, at a restaurant called Faster Pasta, the financial goal might be higher profit margins. The customer goal, fewer complaints and more repeat visits. Internal goals, faster service and less waste. Learning goals, better training and new recipes. Linking all 4 keeps the business aligned and competitive. The building block model by Fitzgerald and Moon focuses on service organizations. It has 3 parts. First, dimensions, 6 areas: financial performance, competitiveness, quality, flexibility, resource utilization, and innovation. Second, standards. Targets should be achievable, fair, and within managers' control. Third, rewards. Must motivate and link clearly to performance. This model encourages fairness, accountability, and sustained improvement. Performance results must always be interpreted in context. Market conditions, competitor actions, inflation, or exchange rate movements can change outcomes. Stakeholders such as shareholders, employees, lenders, customers, and the community each judge success differently. Effective performance evaluation considers these external influences before drawing conclusions. Sustainability is now central to performance management. Businesses measure energy and water usage, waste and recycling rates, emissions, and staff welfare, including sustainability metrics within the Balanced Scorecard. Under environmental and social perspectives, ensures decisions support long-term profitability and responsibility. Sustainable performance protects both reputation and future cash flows. To summarize, financial indicators reveal profitability, efficiency, liquidity, and risk, the quantitative side of performance. Non-financial indicators show qualitative drivers such as service, innovation, and culture. The balanced scorecard links strategy to measurable outcomes, and the building block model ensures fairness and motivation. Good performance management always considers stakeholders, market context, and sustainability. Performance measurement is not just about numbers. It is about insight, learning, and continuous improvement. Thank you for watching this ACCA Wiz session on performance measurement and control. Welcome to ACCA Performance Management Chapter 14, Divisional Performance Measurement and Transfer Pricing. In this lesson, we'll explore how large organizations measure divisional results and set internal prices for goods or services. By the end, you'll understand ROI, transfer pricing methods, and how to calculate the optimal transfer price that ensures fairness and goal congruence. Divisionalization means splitting a large business into semi-autonomous units. Each division acts like a mini-company responsible for its own costs, revenues, and sometimes investments. This improves accountability and motivation, but also requires fair and consistent performance measures. There are four main types of responsibility centers. A cost center focuses on cost control only, for example, an IT department. A revenue center aims to maximize sales but doesn't control costs. A profit center manages both costs and revenues, such as a restaurant branch. An investment center handles costs, revenues, and capital employed, like an entire business unit. Investment centers are measured using return on investment, ROI, and residual income, RI. For example, in Merit International, the housekeeping department is a cost center. Its focus is cost control and operational efficiency. The reservations department is a revenue center because it drives room sales and event bookings. Each individual Merit hotel operates as a profit center, managing both income and expenses to maximize property profit. Finally, Merit's corporate development team functions as an investment center, responsible for new hotel openings and capital returns across regions. ROI equals operating profit divided by capital employed times 100. It shows how efficiently a division uses assets to earn profit. ROI equals operating profit minus capital employed times cost of capital. It measures absolute profit after charging for the cost of finance. IOI is simple to compare but can discourage new investments. ROI is better for long-term decisions because it supports goal congruence. Managers accept any project earning more than the company's cost of capital. Let's look at an example. Division X currently earns 25% ROI but is offered a new project that gives 20% ROI. The company's target return is 18%. If managers are judged only by ROI, they'll reject the project even though it increases company profit. This is dysfunctional behavior. Using ROI solves this problem because it focuses on total pounds of profit, not just percentages, ensuring managers act in the company's best interest. Divisional performance can be compared using variance analysis, profitability ratios, and non-financial indicators such as customer satisfaction or staff turnover. Always remember controllability. Managers should only be judged on results they can actually influence. Now, let's move to transfer pricing, one of the most exam-tested areas in this chapter. A transfer price is the price charged when one division supplies goods or services to another within the same company. For example, a production division might sell components to a retail division. The purpose is to motivate both divisions while keeping overall company profit maximized. The objectives of a transfer pricing system are: goal congruence. Decisions should benefit both the division and the company. Fair performance measurement. Transfer prices shouldn't distort divisional results. Autonomy. Managers must feel responsible and empowered. Accurate cost tracking. Internal trades should be properly recorded. Wrongly set prices can lead to conflict or poor decisions even if total company profit stays the same. There are four main methods of setting transfer prices: cost-based, market-based, negotiated, and dual pricing. Each has pros and cons depending on capacity, competition, and managerial freedom. Cost-based pricing uses internal production cost as the base. If there's spare capacity, the price should equal variable cost. If the division is fully utilized, include fixed cost or markup. It's simple and ensures cost recovery but ignores opportunity cost, which may reduce goal congruence. Market-based pricing sets the price equal to the external market price. This works well when a competitive market exists because it reflects true opportunity cost. It promotes fairness and autonomy. Managers behave as if they were independent. However, if no external market exists or prices fluctuate heavily, this method may not work well. Negotiated pricing means the buying and selling divisions agree on a price that works for both. It offers flexibility and autonomy but can take time and cause disputes. Dual pricing credits the selling division at one price, say market value, while charging the buying division at another, often cost. It reduces conflict but increases administrative complexity. Now, let's discuss the optimal transfer price, the price that achieves goal congruence and fair performance measurement. The rule is simple. Transfer price equals variable cost plus opportunity cost. Variable cost represents the extra cost of production. Opportunity cost is the contribution lost if the product could have been sold externally. This formula ensures decisions that are good for the company are also good for each division. When setting prices, we calculate minimum and maximum transfer prices. The selling division's minimum is the lowest price it will accept. The buying division's maximum is the highest it's willing to pay before sourcing externally becomes cheaper. If spare capacity exists, the minimum equals variable cost. If there's no spare capacity, minimum equals variable cost plus opportunity cost. Transfers only occur when minimum less than or equal to maximum. Otherwise, one side loses out. Here's a simple example. Division A's variable cost per unit is £10 and the external selling price is £25. If spare capacity exists, the minimum transfer price equals £10. If there's full capacity, minimum equals £10 plus £25 minus £10 equals £25. If the buying division can buy outside for £25, any internal price between £10 and £25 works. That's the feasible range ensuring both divisions and the company gain. Comparing approaches. Cost-based works best when there's no external market and spare capacity. Market-based ensures goal congruence when competitive prices exist. Negotiated maintains autonomy and motivation. Dual pricing helps resolve internal disputes. Always explain in exams which method fits the situation and how it affects behavior. Transfer pricing is not only about numbers, it's about behavior. Poorly set prices can cause divisions to compete instead of cooperate. Managers might reject profitable projects or argue over fairness. A well-designed system promotes motivation, autonomy, and team alignment. Always mention these behavioral factors in your written exam answers. They are worth easy marks. Let's recap this chapter. Divisionalization promotes accountability and faster decision-making. ROI and ROI are the key performance measures for investment centers. Transfer pricing aligns divisional actions with overall company profit. The optimal transfer price equals variable cost plus opportunity cost. Transfers should only happen within the minimum-maximum range. And finally, always consider the behavioral side. Fairness, motivation, and cooperation matter as much as the calculation itself. Thank you for watching this ACCA Wiz session on divisional performance measurement and transfer pricing. Welcome to ACCA Wiz. Today we cover performance measurement in not-for-profit organizations and the public sector, how to evaluate success when the goal is public value, not profit. By the end of this session, you will be able to comment on problems with non-quantifiable objectives, explain challenges caused by multiple objectives in not-for-profit and public sector organizations, describe how performance can be measured, and explain value for money in the 3S economy, efficiency, and effectiveness. Not-for-profit and public organizations deliver public benefit, not profit. They are funded mainly through taxes, grants, or donations. Examples include NHS hospitals, local councils, universities, and NGOs. Because there is no single profit metric, we must measure success in other ways. These organizations provide services, not products. Their focus is on achieving social outcomes, not financial returns. There is no investor ownership expecting dividends, and they have strong accountability to taxpayers, donors, trustees, and the public. In commercial businesses, success is measured through profit, return on investment, or earnings per share. In not-for-profit organizations, success is measured by social outcomes and value for money through the 3 Ss. Funding sources differ. Private firms rely on shareholders while not-for-profits depend on public funds and donations. Beneficiaries differ too. Private firms serve owners, while not-for-profits serve society. Let's begin with the problem of non-quantifiable objectives. Goals such as improving health, reducing poverty, or increasing literacy are meaningful but hard to measure. Simply counting activities, like meals served or books distributed, doesn't prove real impact. There are 3 key difficulties. First, there is no clear benchmark for success. Second, it is difficult to compare performance between periods or across organizations. Third, accountability is weaker, as success cannot be precisely measured. This can encourage managers to focus on short-term visible outcomes instead of meaningful long-term results. To handle non-quantifiable objectives, we use proxy indicators such as satisfaction, participation, and awareness. Qualitative surveys and impact studies can help. We should balance inputs, outputs, and outcomes for a complete evaluation. Take an example of a healthcare service. Its objective is to improve patient well-being. Quantitative measures include waiting times and recovery rates. Qualitative measures include patient satisfaction and empathy of staff. A balanced mix of both reveals true service performance. Performance in not-for-profit organizations is measured at 3 levels: inputs, outputs, and outcomes. Inputs are resources such as funding, staff time, and facilities. Outputs are services delivered, like patients treated or students taught. Outcomes are the long-term effects, such as reduced illness or higher literacy. Financial and non-financial measures should be used together. Financial indicators include cost per service, budget variance, and utilization of funds. Non-financial measures include quality of service, accessibility, satisfaction, and public trust. Together, they reflect stewardship, accountability, and effectiveness. For example, in a public school system, inputs include teachers, budgets, and facilities. Outputs are students taught and attendance rates. Outcomes include higher literacy and lower dropout rates. This structure links spending to real social value. Stakeholders in not-for-profit organizations have different expectations. Governments care about policy delivery and cost control. Taxpayers want transparency and fair use of funds. Donors expect efficiency and integrity. Employees want stability and growth. Beneficiaries expect accessible and high-quality services. Because funding comes from public sources, accountability and transparency are essential. Organizations must justify spending and demonstrate results. External audits and reviews, such as those by national audit offices, build public confidence and maintain funding. Not-for-profit organizations face the challenge of multiple objectives. They serve many stakeholders with conflicting priorities. For example, a hospital might aim to improve service quality while reducing costs, or council may try to improve housing and protect green areas while cutting expenditure. Management must prioritize and balance trade-offs. One way to manage multiple objectives is through the balanced scorecard adapted for the public sector. It looks at 4 perspectives: financial, customer, internal processes, and learning and growth. The financial perspective covers budget and resource control. The customer perspective measures satisfaction and accessibility. The internal perspective focuses on efficiency and consistency. The learning and growth perspective focuses on staff development and innovation. This ensures service quality while maintaining financial discipline. Other frameworks also support measurement. The public sector scorecard links stakeholder expectations to outcomes. The logical framework maps how inputs lead to outputs and outcomes. Benchmarking compares performance across agencies to share best practices and identify improvement opportunities. For example, a comparison between 2 councils shows how benchmarking works. Council A recycles 70% of waste at £24 per household, while Council B recycles 55% at £28 per household. Council A clearly performs better in efficiency, cost, and satisfaction. Value for money, or VFM, is a central principle in the public sector. It means achieving the best possible outcomes from available resources. VFM is evaluated through the 3 E's: economy, efficiency, and effectiveness. Economy is about obtaining resources at the lowest suitable cost. Efficiency means producing the maximum output from the inputs available. Effectiveness means achieving the organization's desired goals and outcomes. In practice, consider an NHS hospital. Economy means negotiating better supply prices without compromising quality. Efficiency means optimizing staff and equipment schedules to treat more patients. Effectiveness means improving recovery rates and patient satisfaction. When all 3 E's work together, the organization achieves true value for money. To ensure accountability, public spending is reviewed by independent bodies such as the National Audit Office. These audits assess whether funds are used responsibly, whether objectives are achieved, and how performance can improve. However, measuring performance in not-for-profit organizations isn't easy. Intangible benefits such as community happiness are hard to measure. Long-term outcomes, like better education or improved health, may take years to appear. Political pressures and budget cycles can distort priorities and push organizations towards short-term actions. Let's summarize the chapter. Not-for-profit organizations face problems measuring non-quantifiable and multiple objectives. They overcome these challenges using proxy measures, balanced scorecards, and other frameworks. Value for money is achieved when economy, efficiency, and effectiveness align to deliver public benefit. Performance in the public sector is not about profit, it's about accountability, fairness, and long-term improvement. Success means balancing cost control with service quality and real social impact. Thank you for watching, and I wish you the very best of luck in your exams.